Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. As we have seen from previous presentations, different stakeholders have different interests or things they want to get from a business. However, we are also aware that as much as a business would like to meet the interests of all its stakeholders, it is unable to do so. It just doesn't have the resources to do so. As such, these issues, coupled with the knowledge that stakeholders have different levels of influence and impact over a business, can create what is called stakeholder conflict. This is an important concept and one which we will look at during this presentation. So what are we going to learn in this presentation? Well, first of all, we're going to find out what stakeholder conflict is. And after that, we're going to explore how different stakeholders' interests conflict. So what is stakeholder conflict? Stakeholder conflict occurs when the interests of stakeholders differ, but more importantly, clash. For example, when the actions of one stakeholder negatively impact the interests of another. Now, this conflict can occur when a stakeholder getting or trying to get what they want from a business prevents another stakeholder from obtaining what they want. This creates a conflict of interest between the stakeholders. And as you might already have worked out, such conflicts are most likely to occur when a business makes decisions or when one stakeholder tries to use their influence to impact the business. So with that in mind, let's turn to look at how stakeholders' interests may conflict. So what stakeholder conflicts can occur? The best way to find out about stakeholder conflicts is to look at some examples. So let's turn to our first one, and that is a conflict between managers and employees and between shareholders and employees. One decision that a manager or a director in a business may make is to try and cut or control costs. This is good for the manager or director because if they can cut costs, this should increase profits, which means they will be seen to be doing a good job, especially if the increase in profits is paid out as a higher dividend to shareholders. However, if managers cut costs by sacking staff, reducing staff hours, or refusing a wage rise, then clearly employees would be upset. As can be seen in this example, one stakeholder is not getting what it wants, and that's because there are limited resources and not enough to go around. This poses an important question, which is why were the managers' and shareholders' interests prioritised over those of employees? The simple answer is influence and impact. The shareholders and managers in this particular situation had more power than the employees, and hence got what they were interested in. However, the story may not end there. If employees are not happy with the outcome, they may take industrial action by going on strike. This, of course, could create further stakeholder conflict, because if employees go on strike, a business will not be able to open. As a result, customers won't be happy as they will not be able to shop in the store. Managers and directors will also not be happy because if customers cannot shop in store, sales, profits, and customer loyalty may be negatively affected. Another decision that could cause a conflict is if a business decides to increase production. This will please employees as managers may offer overtime so that products can be made. The government may also be happy because the business may take on more staff, which would reduce unemployment, and suppliers would be pleased because the business will need to purchase more inventory to increase production. However, if a business were to increase production, this could cause a rise in pollution levels and traffic congestion, which the local community and pressure groups would not be happy about. Stakeholder conflict would also occur if a business were to move production abroad. This decision would please managers and shareholders because setting up production abroad in countries like China allows a business to reduce its costs and increase profit. However, employees especially would be upset because they would lose their jobs. Suppliers as well would also be affected, as they would lose contracts from the business, meaning they may have to sack staff as well. This of course would affect the local community and the government, because unemployment would rise and the local area would fall into economic decline. A fourth stakeholder conflict could occur if managers and directors in a business ask their supplier to purchase inventory on credit. This would be positive for the business, as they would be able to sell the stock, receive the cash from customers before they were due to pay their suppliers. This is clearly great for the business's cash flow and liquidity, and would mean the business would be less likely to go overdrawn on their bank account, which would also keep the bank happy. However, suppliers, for the exact opposite reason, would not be happy. Their cash position and liquidity would be negatively affected, because until they are paid by the business, they still have to pay their employees and their bills. This means they may have to borrow money from the bank in order to afford this, which could be expensive. Another way in which stakeholder conflict could occur is if the government were to pass new legislation. For example, if the minimum wage were increased, employees on that wage would receive a rise and therefore would be very happy. However, managers and shareholders may be disappointed, as paying staff a higher wage would increase costs, which may cause profits to fall. Another way in which stakeholders may conflict is if the business's bank refuses to lend them money. This would upset the directors of business, as it may prevent them from growing the business in size. But worse than that, it may mean that the business runs out of cash and therefore is unable to carry on. A final conflict could occur between the government and the directors in a business. Although this would please shareholders, as profits would not be taxed as much, the government would be unhappy, as they would be receiving less tax revenue to pay for public services such as health and education. So what did we learn in today's presentation? Well, first of all, we found out what stakeholder conflict is. And then after that, we explored how the interests of different stakeholders can conflict. Hopefully this presentation has shown how dealing with the different interests of stakeholders can be extremely complicated. In fact, when coupled with the knowledge that stakeholders can significantly influence and impact a business, it is clear that organisations have to be very careful how they manage stakeholders. This is why many organisations choose an objective which we did not mention during the objectives presentation, and that is satisficing. Satisficing is an objective which realises that trying to satisfy or meet all stakeholders' interests in full at the same time is impossible and may in fact cause conflict. For example, it would be impossible to sustain year-on-year increases in employee wages, shareholder dividends and supplier inventory costs. As such, rather than trying to meet all stakeholders' interests in full, a business will aim to satisfy the interests of each stakeholder enough that they do not attempt to negatively influence and impact the business. For example, a business may give employees a smaller pay rise than they would like, but one which they would accept so that they don't take industrial action. The same would also hold for shareholders. The business may pay out a dividend which is lower than shareholders would like, but enough to stop them from selling their shares. So what we can see is that satisficing as an objective is a way of helping a business avoid stakeholder conflicts. By doing enough to keep all stakeholders happy, the business will be able to move forward without stakeholder conflict disrupting it.